Ashwini Agarwal, founder at Demeter Advisors, as to what's his piece of advice for investors. Ashwini, hi, good morning. Good to have you on the show as always. I recall when we were talking in June, you were talking about as to how, long term, there is no concern in the market, but short term, we have Trump to deal with, and nowadays, pretty much on a daily basis. So what should Indian investors be picking out from all the news flow right now, Ashwini?
So, Aisha, thank you for having me here. And as your previous guest was saying, I think the right thing to do at this point in time is to look a little bit longer term and ignore the short term noise. I mean, you were talking earlier about pharmaceutical exports and where President Trump has said that he would be imposing very high tariffs on pharmaceuticals because he wants pharma companies to invest and manufacture in the United States. One has to remember that even if companies were to start investing today, it will be at least 3 to 4 years before any production can roll out. And by then, the current president's term would be over. So I think, tariffs is one thing, but economic decisions that companies make tend to be longer term in nature, and investors, that is the companies, will think ahead and ask a tough question as to does it make sense to make low price generics in the United States with the cost factors that prevail in that system. So I think the answer is very clear to me that you have to muddle through this market. You have to sort of take the pain for now and hope that in the long term things will become a little more rational. And that's the only way to go. In the short run, we are also facing trouble because the earnings season has been quite weak, and there is a massive supply of paper via the IPO market. So you've got kind of a multi-factor headwinds, on the market in the short run.
Sure, but Ashwini, what's in it for investors then? I mean, are we looking at weaker days ahead? Because July already has had a bit of a, rough patch for us. FIs already have been on a selling spree. Could it get worse than this before it gets better? Or do you think we'll continue to be now range bound because we've had some, incessant selling, and looking at the short positioning, it seems like it's pretty acute. It couldn't get worse from here.
Yeah. So in the short run, I think the downside is somewhat limited, maybe 2-3%, 4% from here. That's my personal opinion. I could be completely wrong because short term is honestly impossible to predict very accurately. And I do agree that in the medium term, my hope is that lower interest rates and easier liquidity that has been pursued by the RBI over the last 3 to 6 months will start to help domestic demand. Obviously, there is going to be some trade-off there if the tariffs remain as high as have been proposed on exports to the US. There might be some headwinds from there, but overall, I'm hoping to see a stronger domestic demand during the festival season, and that might help the market. So, that's what my hope is. Now, if for whatever reason domestic demand continues to stay subdued, despite all the liquidity in the system and despite all the push that government is making via capex and the PSUs and so on, if that happens, then I think bets are off. Then I think, you could test even lower levels on the broad market basis. Having said this, for investors, I would suggest that look for the long term. And I think, the downside from here appears to be fairly limited on the assumption that liquidity and interest rates will help demand as we go along. But also look for bottom-up opportunities. There are a lot of stocks which are down 40-50%, from their peak in September 24, and where valuations are now no longer very challenging. And if one were to look out 2 years or 3 years out, many of these stocks offer very interesting investment opportunities. So that's one area where people who invest in stocks can look at. Otherwise, I would say just stay invested, ride it out. There's nothing to be done.
That's quite interesting. Ashwini, get specific with that. Which are these pockets where you think there is some, bottom-up opportunity?
So, one straightforward area is the non-banking financial services and the MFIs. Now, if you look at the commentary from each of the MFIs, they're all indicating that at the margin, incremental NPLs are not happening or are fairly controlled. What is washing through the system is the NPLs that have already been identified and they are being provided for. Maybe there's another quarter of pain or so. Several of them have recapitalized. Many of them continue to trade at near book value or below book value. At the peak, some of them were trading at 3 to 4 times price to book. Now, I would not suggest that 3 to 4 times price to book was a rational number, but maybe 1.5 times is not such a bad number to expect, or even 1.2 times in certain situations. And if you're able to buy these stocks at below book value on a year and a half basis, you could make 30 or 40% return, which is not a bad return to make. I mean, that's just an example, right? So there are several such ideas, whether in the domestic consumer space, whether in financial services, and these are across industries. So you have to look deep. There is obviously some risk involved, and you have to think a little bit medium term. But I think there are opportunities.
Right, Ashwini, other than the sectors that you've just mentioned in terms of NBFCs, MFIs, select consumption plays, given the kind of consolidation that we've seen for our markets recently, and we've been rather range bound, any sector you think looks attractive now in terms of valuations, having seen some correction, or on fundamentals to any other sectors, any other pockets that you think could, for as of now, given the kind of volatility we have, could prove to be a sort of a safety net for investors?
Sting, my sense is that it's not the time to be sector oriented. It's a time to be very bottom up, individual stock oriented. And again, in the short run, temper return expectations, but look in the medium term. Now, let's, for example, take textile exports. Okay. Obviously, they will get hit if these tariffs are imposed, especially for companies that have a high salience of United States in their sales mix. And if stock prices react significantly negatively, you might have an opportunity to buy them as well. But you'll have to ride out a couple of bad quarters. I mean, that goes without saying. So I'm saying that, I don't think I can identify broad sectors, but I think I'm able to identify individual stocks. I mean, outside the finance sector, maybe there is domestic healthcare, which looks okay. Some of the other domestic consumption stocks look okay. I think there are a smattering of them from a sector perspective, but I think on a bottom-up basis, you have a lot of opportunities.
All right. Hi, Ashwini. Morning. This is Shrishti also joining in. You did give your take on the pharma space, but the other sector that could be in focus is actually the electronic space as well, because for now there has been exemption over there. But if we can put an example or a name there, it's Apple, which has the manufacturing base in India. Donald Trump has been demanding to shift that, and just yesterday they committed a large investment in US as well. But with this whole tariff uncertainty, along with pharma, do you think the manufacturing and even the EMS story of India can be a question mark going ahead? Can that be a concern for the investors too?
Shruti, I really can't say, because it's not clear as to whether the tariffs are here to stay or this is a negotiation between the United States and India, which are ongoing, and where the dust will finally settle. I would imagine that in the long run, again, one has to look beyond the immediate term. In the long run, the cost advantage offered by India in manufacturing is here to stay. If our policy framework continues to be supportive, eventually water will seek its own level, and manufacturers globally will seek a production base which is cost competitive. I think that fact doesn't change. So, if this opportunity, if this taper noise gives us an opportunity to buy the EMS companies at much better prices, I think that would be a welcome thing. I found EMS companies to be quite expensive. I tend to have a value bias, so I really haven't fished around in that area yet. But yeah, if stock prices weaken because of this noise, that might be an opportunity. I think long term, the competitive advantage is here to stay.
Interesting. Okay, so Ashwini, what's on your watch list other than what Trump's commentary is? Anything that you're monitoring in terms of, I mean, not just earnings, but maybe dollar, rupee, some other global markets as well as a watch list?
No, I'm really focusing on the earnings season. And I think, I'm tracking companies which are improving their revenue margin and earnings profile on a quarter-on-quarter and on a year-on-year basis. Where I'm seeing that improvement is sustainable, I think those stocks will do very well. I think one theme that one should look for is earnings recovery, where companies have gone through a down cycle over the last 2 to 3 years, but earnings are now starting to bottom out. Those stocks will do very well, and that's what I'm trying to sort of search for. My sense is that in an overall tepid earnings environment, if there are companies that are delivering 15 to 20% earnings growth, those valuations will expand significantly. So that's what I'm really focusing on right now.
Actually, a great way of thinking. I mean, cut the noise out, look at what's happening here, look at earnings, and the prices will follow. But Ashwini, great to have you on the show as always. Thanks for your time. Okay, let's just revisit where the markets have settled in at. The resilience continues. We've not fallen too much. We're marginally